Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about where mortgage rates are headed for the rest of the year, given Fed policy, economic headwinds, tariffs, and more. I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
Happy Jobs Friday! What a week we survived. And I got to bring the Red Hulk and Trump and Powell out this week. This AI stuff is just wonderful. I'm going to have so much fun.
You're dangerous with this AI stuff. I'm telling you that your hilarious social media things on this, it's very entertaining.
Now, of course, I'm not a political economic theory guy. I hate talking about, but because it's the Fed and mortgage rates and housing, I'm obligated by duty to do this. So I'm going to have fun with it, and it's been an interesting week. Now, of course, by the time people listen to this podcast, Jobs Friday is out, and who knows where the 10-year yield is doing there. But with everything said, it's Thursday morning, and what happened Thursday morning? Jobless claims is good, nothing bad there. The inflation data, the personal consumption expenditures, that's where the Fed really puts their weight on, more than CPI inflation. That showed goods inflation picking up. So the Federal Reserve told everybody they believe starting in June all the way for the rest of the year that they're going to start to see some of the goods inflation. So the total report itself wasn't anything too dramatic, but you could see the underlying curve of stuff coming into the inflation data on the good sides. And PCE, the service inflation isn't as big as it is for CPI data. So it's something to think about going out. So we had a hawkish Fed. We had Powell basically Empire Strikes Back against, Trump. Trump went ballistic this morning. That's why I did that video of me with super blonde hair screaming like a lion, because that's probably what Trump did yesterday. And he went out and just bombarded Powell again Thursday morning. And with the inflation data underneath it, a little bit hotter, 10-year yield is down slightly today. Not much. It's around that 435 level around. That's what we talked about. That's been our main focus all year with Fed policy. It looks about right. And a lot of people say, well, the Fed doesn't control mortgages. Oh, yes, they do. 65 to 75% of where the 10-year yield, what do we always say? We teach people this way. The 10-year yield and 30-year mortgage rates have had a slow dance relationship since 1971. It goes back further, but my charts only go there. And then they slow dance with each other, and that's really driven about Fed policy, nominal growth, inflation data. But the spreads is literally the number one mortgage story of the year now, because the spreads, there's no volatility that much in rates, and this is tested. So I'm waiting to see how Friday's pricing does. But question is, let's go out in the future. What do we look for now?
Okay, well, first, what is that 430 rate on the 10-year yield? How does that translate to mortgage rates? What does that normally mean?
So this is why I talk about that 435 on the 10-year yield a lot. When Godzilla tariffs came and stocks were down 20%. Money went into the bond market like crazy, and it took the 10-year yield down to, I think, 3.87 overnight trading or trading early in the morning. My whole range on the 10-year yield was almost met because of that. It's like 470 to 380. But the spreads weren't that great. Mortgage rates got down to 6.55%, I think, at that point.
Wow.
But I even said on that day, it was April 4th, it was Jobs Friday, I said, we don't belong here. We belong at 435. If Godzilla tariffs are off, we're belong. And what happened? 90-day rules, they set some exemptions. We're doing some exemptions or some delays with Mexico today. 10-year yield got up to 435, went up a little bit higher. So where we are with Fed policy right now, the 10-year yield looks right, but mortgage rates are acting better because the spreads are better. And if the spreads didn't improve, we're 7.5 to 7.75, around there, and the housing market acts worse.
So instead, where are we with mortgage rates right now?
About 6.75 right now today, as of this second. I just saw the pricing right. So there it goes. And because the spreads are good, we get better housing data when it's 6.64 down to 6. We're not that far off.
We're so close.
And the spreads have room to improve. Like A lot of people said that mortgage spreads could never get down to 2% ever again in history because they overweight the Fed's involvement in that. The Fed, we have decades and decades. I stress to everybody, we have decades and decades without the Fed buying mortgage-backed securities, and the spreads are somewhat acting normal. They're a little bit slower to go down, but also the Fed rate cut cycle has been a little bit slow. But if you look at the history, there's nothing abnormal. We are not that far from getting on 2% on the mortgage spreads down there. So 310 was the highest level in 2023. That gave us 8% mortgage rates. So when you look at the spreads, normal is 160 to 180. We're 2.28 at that one point. We're not that far from even getting closer to normal. So all of this is a positive because you just get a little bit better 10-year yield and better spreads, 6% mortgage rates. Things act a little bit better in that. And that's why we always wanted to highlight the spreads discussion in the tracker, because if I was right starting in 2024, they should improve. They have improved. They stayed improved. And whenever yields go up, they get better. So it's giving the mortgage rates a kind of a cushion on higher yields days. That's a positive because demand could even be worse. So going out in the future, though, what do we want to see and how does the bond market react to what?
Okay, so first question is, has anything changed in your forecast for rate cuts coming up? Do you see it in September? Where are we going to be?
So for myself in 2025, it was always 2 rate cuts. Of course, because of Godzilla tariffs and everything, things are delayed. I'm just going to stick with the 2 rate cut camp always. I don't like to change my forecasts ever. If you've noticed that, I just kind of move with the data because I rather teach people what can change something. Rate forecasts, hikes and cuts and everything is a very fast moving variable, right? And today's a really good example. In any other circumstances in the last 3 years, bond market yields would be rising and mortgage rates would be rising. But what is the big difference? The personal consumption expenditures, I'm going to be nerdy here, 6-month annualized inflation adjusted spending went negative today. That means the spending for the first half of 2025 was very slow to the point that that data line showed a negative number. It's really rare for that to happen. What do we talk about GDP? The GDP data, the consumption data that the Federal Reserve has basically focused on and said, this is what we hold our hats on. That was weaker in that. Going out in the future, why do you think Trump wants emergency rate cuts? Because he knows that if goods inflation picks up just a little bit, right, it's easier to deal with a trade war with lower rates. We went on CNBC, four months ago, or a few months ago, and on live camera said the cure for tariffs, because what Trump wants is lower rates. Why? When Trump saw what happened during COVID, we had all this inflation, right? And people were buying homes and stuff and everything. Why? Because rates were low. Right. So it wasn't the inflation that was killing it. When rates are lower, buyer capacity grows. So that's kind of what he wants for housing. This is why he keeps on pounding on housing, because it's the Trinity effect. If you could get the mortgage rates sub 6%, he would be just thrashing every country in the world and everyone, and the economy is super duper wonderful. But right now, I'm just going to go with 2 still. And if the consumption data gets weaker, those 2 are solidified. But the fight becomes, if goods inflation starts to pick up and total inflation doesn't really get out of hand, what does the Fed do in that context? Because if I would tell you this, if there were no tariffs today and they didn't cut already, they would have done a 50 basis point cut yesterday.
Wow.
That is what would have happened yesterday, because the consumption data is slowing down and they are modestly restrictive. Because they are modestly restrictive and that consumption data, they would have cut half a percent if they didn't cut before already, because they're playing catch up. But because the labor force growth is slowing down, the unemployment, they're using all their usual tactics to stay as restrictive as possible until the labor market breaks, and they're going to go, oh, I've got my cover. Now I've got my cover in my dual mandate. Dual mandate, we do dual mandates differently. 2 guns, walk 5 feet, turn around, boom. Who shoots who first? Labor or inflation? Dual mandate. What guns? Who would you take? Alexander Hamilton? But that's where we are right now. It's going to be this crazy battle between goods inflation, consumption data, the labor markets. What is Powell going to say going out for the rest of the year? I mean, if I was Trump, if I was President Trump today, you know what I would do? I'd be like, Christopher Waller is the next Fed president, Fed chairman right now. I would just name him right now. Now, I've always told people wait until October until this. They're really pushing this out later on. But Bessent came out and said they're going to give some candidate names toward the end of the year. So it's not anything, but that's what I would do if I was Trump. I would just say Chris Waller.
He becomes the shadow Fed president. You're not saying he should appoint him and like fire Powell and appoint him now.
No, not fire Powell. Let Powell stay all the way. Don't fire Powell. Forget this construction stuff. Get with something that can do something, right? The shadow Fed president is something that can actually somewhat work to a degree, but you can't put wars. You can't put, just put Waller in, and then the market's going to go, Powell's done. Do I really want to listen to a guy that I know is not going to be there? That was the whole concept of the shadow Fed president. If you're going to talk about it, pull the trigger. What are you waiting for? Come on. Well, New York ball, get into it. You all talk about this for like 6-7 months. What's the point if you're not going to pull the trigger? So if you're hearing this, if anybody in the Trump administration is hearing this, pull the trigger. Stop talking about it. Stop wasting time on this construction, whatever. Powell is not going to quit. Powell's not going to leave. Yep. You can't fire him. Get to the next stage.
And you started writing about the shadow Fed president based on what the Treasury Secretary, Scott Bessent, had written about the shadow Fed president in the fall. So this is not your idea. This is just you shining a light on it, saying this is the strategy that they've already laid out.
Do you know when this all really started? Was when Steve Mnuchin, who was the Treasury Secretary in Trump, Steve Mnuchin, I wish he was still on the team. He basically talked about, well, we don't want the 10-year yield to go above 4.5%. Yield control. It was some geeky stuff. But if he's talking about that in 2024, and Bessent was talking about a shadow Fed president in October, before even Trump won, you could say there was a game plan set. Now, nobody knows what the shadow Fed president is. We were talking about this for like 6-7 months, and everyone was like, what the hell are you talking about? It sounds like some sinister project or something, or some spy movie. But that was the game plan. But man, it's August. When are you going to pull the trigger here? If you're going to talk, pull the trigger. If you're not, this is why this whole reconstruction thing is, you're not going to fire him. He's not going to quit. All you did is made Powell more resilient. The man is literally going to rather die than leave the Federal Reserve now. Okay. This is what happens when you try to play bully ball and somebody's going to fight back. Right. So, do it. Why? What are you waiting for? At least let the market say, okay, I got a guy who was voted for rate cuts. You already got it on record.
Right.
So move it to the next phase. Now, of course, this isn't going to be what Trump wants, 3% rate cut. No, that's not going to work. And I think Bessent knows that. But, if you want to get down to neutral, it does not, we're so close to getting to that next level. The spreads are better. So there's things that can happen out there. So it's very exciting. As you can see, I'm very excited right now. This is fun. Okay. This is like nerdy Super Bowl time. Halftime is over. Let's go.
So, yesterday, so we're recording this on Thursday. So on Wednesday, when the GDP came out, Trump was like, GDP is great. We should cut rates. It's like, I don't think that's the way that works. And lots of people, I saw lots of people being like, if the economy is doing well, if it's outperforming, that's not when you cut rates, correct? If to cut rates, you need to see things getting worse.
It depends on where the Fed funds rate is.
Okay.
So the reason I say this is because the Federal Reserve said modestly restrictive. We're not at neutral. Okay. So they gave themselves leeway to cut rates to get to neutral. Now, when you looked at that GDP number, the internals weren't that great. Now we look at the personal consumption spending numbers. So this gets into the nitty gritty. Of course, Trump is such a polarizing figure that, of course, when he says it's the best economy ever, cut rates, same thing he did in 2018 and 19, right? But back then in 2018, 19, there was actually a case to be made for cutting rates. Business investment went to zero. We have talked about this for a long time. When you went back to first Trump presidency and the trade war tap dance, that was a very, very small trade war compared to what we're doing now. And business investment went down to zero, right? And housing was slowing down because rates went up. The dollar was too strong. Now, I just wonder how frustrated Trump must be because he got the dollar lower. The dollar's finding a bottom right about here now, too. Also, energy prices are lower. He just needed that 10-year yield and spread to get better. He could have ran with it. But my thing is, this is the political economic thing that I hate because it's all, it's a show, right? It's a circus, right? So you don't say it's the greatest economy in the world and, well, we need emergency rate cuts. That doesn't make sense. Poor Speaker Johnson goes on TV and says to CNBC, the economy's hot, and the CNBC actors, and why do you need 3% rate cuts? So we get into this, and this is where political economic is just like, I have to like step back. It's like none of this stuff would make sense to me, but I understand why they do it. I can't operate that way. So I'm just trying to get people to realize we are talking about going to neutral because we have never, ever once talked about accommodative policy. That has never been any of the subject, right? That's when the labor market breaks. And what does the labor market need to break? Jobless claims. 323, 4-week moving average. It's August 2025. All those recession calls have been wrong. Since 2022, when we had our 6 recession red flags up and we said, okay, we're going to keep an eye on claims and residential construction, and then the 10-year yield went down and single family permits rose. That was it for that, right? That thing was null and void. But now, it's going to get fun. Oh, the AI game is going to get even better. Sarah Wheeler, I am glad that you're here to witness this because it's going to be a heck of a time for the next 5 months of the year.
Okay, so put yourself in the LO position, though. Not as much fun if you're trying to figure out what's going on. For the rest of the year, you're keeping your forecast the same as it has been, but
I have never changed my 10-year yield channel forecast ever in my life, and I never will. My 10-year yield channel takes into a lot of things that can happen within a year and gives a reasonable range. This year, didn't matter what the Fed was doing, 380, Hodor. The Hodor line was the bottom, and then 470, okay? 435 to 470 looks right with Fed policy now. If you start to get more discussion of rate cuts, you can go a little bit lower. Everything kind of looks right in that. But this is the geeky
range,
technical.
What's the mortgage range for that?
7.25 to 5.75. So right now we've got 7.25 to, I think, 6.5 was the low point. So the bottom half has not happened because the labor market has not broken yet. Last year, it's really interesting. Last year, same range, 7.25 to 5.75. We had 7.5 down to 6%. But last year, the markets were hell bent that we were going into a recession. And all it was job growth was slowing down. We tried to tell you guys that last year, that, mortgage rates were really priced in for a bad economy and, quick reversal. It's like the Gandalf line and the Hodor line, quick reversal. So keep an eye on this because you have room to go lower without the Fed getting any kind of aggressiveness for two things. If the economic data starts to get weaker, bond market has told you they'll go lower, and the spreads are better now. The spreads are better now means we don't need the 10-year yield to go below 4% anymore to get 6% rates. If the 10-year yield can just head down there with better spreads, we're not that far off from the year-to-date lows today as we talk. It's a little bit different portion of the economic cycle. So very exciting. I hope all my nerdy friends that are listening to me can understand why I'm so excited. I think you all get me. This is it's fascinating stuff right now with the economy, the Fed, and tariffs and everything. It's been decades, that we've had high percentage of tariffs and how that works. So we all get to test run a new economic cycle for us, which is very fascinating.
Watch Jobs Friday and look for Logan's analysis of that. He always writes that up. Look for that today when this airs. And Logan, thank you so much for being on. Appreciate you.
Pleasure.